Imagine a company whose work is so fundamental to national security. It influences everything from, say, the secure internet you might use to the actual tech protecting soldiers. Yet you might not immediately recognize their name. They're sort of a quiet giant in the field. Today, we're taking a deep dive into CCI International Inc. That's NYSE, ticker CACI. We're going to peel back the layers, try to understand what makes them such a standout player in this incredibly complex world of federal contracting. We'll explore how they've evolved over, 6 decades, and also how their strategic direction kind of paints a picture for the future of national security tech itself.
Yeah, and our mission today really is to give you a clear understanding of CCI's very deliberate strategy, its financial health, which is quite robust, and its unique position, you could almost say indispensable position, especially in a market driven by these enduring government priorities. We'll investigate how they've managed to balance, specialized human expertise with really cutting-edge, often proprietary technology, and maybe more importantly, what this balance means for their growth, which is pretty impressive, but also for the wider defense and intelligence landscape. You should walk away with a much clearer picture of this hidden engine of innovation.
Right. And what we'll discover is how CCI isn't just, reacting to demand. They're actively investing ahead of need. That's
Yeah.
their phrase. It's a philosophy that's driven this fascinating and frankly very successful pivot from kind of traditional services to truly groundbreaking tech. We'll explore why, in the 21st century, a company focused on bits and bytes software.
Yeah.
Data is now seen as just as crucial as those making bullets and bombs. So yeah, get ready for some deep insights. Okay, so let's start at the beginning then. Who is CCI International exactly? At a high level, they're a global provider of IT and professional services, mainly serving the U.S. federal government. But just saying IT services feels like it undersells it, doesn't it? This isn't just setting up email accounts.
Oh, absolutely not. It's highly specialized, mission-critical stuff. And what's really remarkable, I think, is their longevity and how they've evolved strategically within this, very dynamic sector. The company was founded way back in 1962. Originally, it was the California Analysis Center, Inc. And that name itself tells you something, right? Their initial focus was specialized data analysis, which was pretty groundbreaking back in the early 60s. They saw that growing need for insights. And then they had the foresight to go public relatively early, 1968. That was, pretty progressive for that kind of company back then. Yeah. Showed an early vision for scale. Over the years, they evolved, eventually became CACI International Inc., symbolizing, a broader footprint, a wider ambition, even if their core client base stayed focused on U.S. national security.
So from those analytical roots, what does CACI look like today? How does that early vision translate now?
Well, today, they're headquartered in Reston, Virginia. Puts them right in that national security corridor just outside D.C.
Yes, strategic location.
Definitely. Allows for close collaboration with their main clients. They have this highly skilled, often highly cleared workforce, maybe 22,000 to 25,000 people. These aren't just employees. They're experts, deep domain knowledge. And like you said, publicly traded on the NYSE, ticker CACI. So their financials, their strategy, it's all out there for scrutiny. Hashtag, be leadership and governance.
Right. And navigating such a complex world, you need strong leadership. President and CEO John Mengucci, he's often called the chief architect of CACI's successful market-aligned business strategy. That's quite a title.
It is, and it seems well-earned, speaks to the intentionality behind their strategic shifts. But what's also really crucial, especially for a company so embedded in government work, is managing leadership transition smoothly. It raises that question. How do they ensure continuity? Keep executing the strategy when there are big changes at the top. They actually navigated a key change recently. Their long-standing chairman, Michael Daniels, passed away in July 2025.
Oh, right.
And the board acted, very swiftly, elected Lisa Dinsborough, who'd been a director since 2021, as the new chair. That kind of rapid internal transition, it minimizes disruption. It shows a real focus on stable governance, keeping that strategic momentum, signals stability to everyone, clients included.
And the board structure itself seems built for that robustness, too. Emphasis on independent oversight.
Absolutely. It's a strong point. 10 out of their 11 directors are outside directors. That ensures a high degree of independent oversight, accountability for management. It's not just, corporate governance best practice. For a government contractor, it signals transparency, ethical rigor to their ultimate client, the government. Adds a layer of confidence.
Okay, so at its heart, the core investment thesis for CACI is that they're positioned to deliver sustained long-term shareholder value. But what does that really mean in practice for a company like CACI? How does it play out?
Well, if you connect it to the big picture, it means their entire strategy is meticulously built around this very deliberate focus,
Hmm.
providing high-end, differentiated technology for mission-critical national security clients. The key insight is they aim to be indispensable. This isn't general IT help desk stuff. It's specialized, often proprietary solutions, vital to core government functions, things that just cannot fail. We're talking tech that enables intelligence gathering, protects critical infrastructure from cyber attacks, supports military ops in real time, often in contested zones. They embed themselves so deeply, their services become non-discretionary.
So it's like they've found this sweet spot, aligning themselves directly with what they call durable, well-funded government priorities. They're not chasing fads, they're focused on essential spending.
Exactly. That deep alignment with stable, often bipartisan funding streams, national security, government modernization, right, it provides a significant buffer. These aren't temporary political whims. They're persistent challenges.
Yeah.
Global threats, cyber warfare, tech superiority. These things consistently get support. So that alignment, plus their huge contract backlog, plus a disciplined capital strategy, it all build a compelling case for predictable long-term growth. They aren't just reacting. They're proactively shaping their future, anticipating needs.
And here's where it gets really interesting for me. CCI's core strategy is this phrase, investing ahead of need. It sounds so proactive, almost visionary. But what does that mean practically, dealing with government? And how does it create a real competitive moat?
Right, and what's insightful is how this strategy builds that moat, that barrier to entry. By anticipating future needs, proactively investing in R&D, developing tech before customers even fully articulate the requirement. CSEI positions itself to capture those higher margin technology contracts. Think of it like this. Instead of waiting for an RFP detailing a problem, they're already building the solution. Often they're showing the government what's possible, what capabilities they will need, and then showing they already have a mature answer ready to go.
So they're not waiting for that RFP to land, which we know can take forever in government contracting. They're almost creating the demand, or at least being perfectly ready with a proprietary solution when it hits. But that sounds like a bit of a gamble, doesn't it? What if they guess wrong?
That's a critical question, absolutely. It highlights the risk. It's not a blind gamble, though. It relies on deep intelligence, market analysis, strong client relationships to understand that long-term strategic direction. Remember their roots in analysis. That plays a huge role. They invest in foundational tech, cyber, AI, space comms, things they know will be critical regardless of specific program shifts. This proactive approach lets them deliver organic growth that often outpaces peers, because they bring sophisticated, often proprietary solutions to complex emerging problems before they become commoditized challenges. They command a premium, secure more valuable contracts, and establish themselves as the preferred provider. It's about being not just a step, but maybe several years ahead.
Okay, so CCI's strategy isn't just a list of goals. They call it a value creation model. That implies something systematic, interconnected.
Right, and that raises the question, what makes a model truly integrated and effective? For COI, each part is designed to reinforce the others. It's not a checklist, it's a self-perpetuating cycle. Success in one pillar directly fuels success in the others. It creates this defensible, resilient cycle. Like strong profitability enables more investment, which leads to more predictable revenue growth. It's not siloed. It's about optimizing the whole system.
All right, pillar one, predictable, sustainable revenue growth. In a market often tied to government budgets, political cycles, how do they ensure that kind of consistency?
This is where that investing ahead of needs strategy really pays off, creating predictability. First, it starts with differentiated capabilities. They don't just aim to have a solution. They focus on having the best or most unique solution because they invested early, gives them a technical IP edge, hard to replicate.
Yeah.
Second, they target enduring funding streams, strategically focusing on national security, government modernization. These aren't temporary whims. They're long-term, often bipartisan priorities. Persistent challenges get consistent funding. That makes their revenue base much less susceptible to short-term budget fluctuations, creates a strong, stable foundation.
And then there's that phrase they use, bid less, win more. Sounds almost counterintuitive, right, for a company relying on winning contracts.
Yeah, it does. But if you connect it back, it's a direct result of those differentiated capabilities, those ahead-of-need investments.
Yeah.
Because they have superior tech and expertise, they can be selective. They don't chase every low-margin opportunity.
Okay.
They focus resources on complex, high-value procurements where their unique offerings give them a much higher win probability, often because they're the only ones with that specific solution. It's way more efficient than competing purely on price for commoditized work. The outcome: more efficient business development, lower bid costs, and critically higher margins on the contracts they do win. Quality over quantity.
Okay, so pillar two. Profitability isn't just about the bottom line for shareholders. For CACI, it's about actively fueling future growth. That's an interesting twist.
Yeah, what's insightful is that profitability isn't just the destination, it's the engine driving the whole flywheel. Strong financial performance directly enables more investment in those differentiated capabilities,
Mhm.
the R&D, the tech, the solutions keeping them ahead, and crucially, it lets them invest in their people. In this market, finding and keeping highly cleared technical talent cyber experts, AI specialists, is incredibly competitive.
Huge challenge, I bet.
Absolutely. So investing in employees, competitive pay, cutting-edge training, a strong culture is vital. It creates this virtuous cycle. Profits enable investment, which drives differentiation in talent, which leads to more wins, higher margins, greater profitability. It's a self-sustaining loop.
Right. And finally, pillars three and four, a disciplined approach to managing capital. Beyond operations, what are their financial priorities? How do they put their cash to work?
Their stated priorities are pretty clear and balanced: share repurchases, strategic M&A, and paying down debt. And they consistently act on this. Like in FY24, they did $150 million in share buybacks. Returns capital, shows confidence. They also made strategic tuck-in acquisitions like Quadrant Inc. Not about massive scale, but filling specific capability gaps like secure cloud.
Targeted additions.
Exactly. And more recently, acquiring Azure Summit Technology, again, very targeted M&A to get innovative tech, particularly in signals intelligence. This flexible, disciplined approach lets them adapt, selectively strengthen their portfolio, always aiming for long-term value.
So CCI has this dual model, expertise, people-driven services combined with high-end tech solutions. Sounds comprehensive, but I understand they've made a really significant, deliberate pivot within that structure recently.
That's spot on. The dual structure lets them serve a broad range of needs, the people power and the tools. But the strategic shift, yeah, it's clearly and deliberately toward the more profitable, higher growth technology areas. That pivot is central. Let's break it down. The expertise segment is mostly talent-driven. Specialized knowledge, IT ops support, intel analysis, engineering services, essential work needs skilled people, often cleared, but generally lower to medium barriers to entry because it's human capital. And lower to mid margins, often time and materials pricing. For the 9 months ending March 31st, 2025, that was about $2.89 billion, maybe 45.7% of total revenue. Now, the technology segment, this is advanced software, hardware, often developed internally, protected by IP, offered as proprietary products or high-value services. Think agile software dev, advanced data platforms, next-gen com.
Right, the cutting edge stuff.
Exactly. Much higher barriers to entry needs big R&D investment, specialized engineers. And crucially, generates mid to high margins because it's proprietary, differentiated. For that same period, technology was roughly $3.44 billion, a significant 54.3% of total revenue.
Wow. So technology is now the majority of their revenue. That's a huge, visible shift, especially for a company with that long history in services.
Yeah.
That kind of pivot for a legacy company must have been tough. Internal resistance, market hurdles.
Oh, absolutely. That's a crucial point. Reorienting like that isn't easy for any company, let alone one of KPI's size and history. The challenges were, well, multifaceted. Internally, it required a cultural shift, moving from we provide the best people to we provide the best solutions and then the people to implement them. Meant huge R&D investment, attracting different kinds of engineers, patiently nurturing long-term tech development. Market forces, too. Government customers increasingly wanted integrated, product-like solutions, not just staff augmentation, and a growing recognition that tech was where the highest value, the strategic advantage, really lay. So this successful pivot isn't just a statistic. It's a leading indicator for future margin expansion, enhanced profitability. It really validates that investing ahead of need strategy proves their long-term vision is translating directly into financial results. #TechTechTechTechTechTechWB. Core capabilities in action.
Okay, that pivot is clear in a revenue split. Let's dive into some concrete examples. What does this tech look like in the real world? Where is ECI making a tangible impact?
Their capabilities line up directly with some of the most critical government priorities today.
Right.
Very strategic focus. Let's start with network modernization.
I imagine that's making old government systems faster, more secure. Sounds like a never-ending challenge given the scale.
It's way more than just upgrading old systems. CCI is seen as a dominant force here, delivering better user experiences while boosting security and efficiency on vast critical networks. A prime example, modernizing the U.S. Army's secure Internet Protocol network. They leverage their commercial Archon technology.
Archon. What's that?
It's this innovative cross-domain solution. Lets you securely share info between different security classification levels. Imagine securely accessing classified and unclassified data on the same workstation. That's Archon. It's about seamless, secure information flow. Paramount for military, Intel Ops. Then there's software development. CACI manages 3 multi-billion-dollar software dev programs across the government. Not just coding, they use modern agile DevSecOps.
Right, agile DevSecOps,
Really?
faster, more secure development.
Exactly. Agile means rapid, flexible delivery. DevSecOps integrates security throughout the entire lifecycle, not just bolted on at the end. This allows for rapid delivery of new capabilities, crucial when threats evolve so fast. Speed and adaptability are key. Moving on to electromagnetic spectrum, EMS, and counter-unmanned systems, CUAS.
Okay, this sounds like high-tech warfare. Detecting, stopping drones, maybe jamming signals. What's CACI doing here?
It is very cutting edge and increasingly critical, a key strategic investment area for them. They're delivering the TLS-BCT Manpack Terrestrial Layers System Brigade Combat Team Manpack.
That's a mouthful.
Ha!
Yeah.
Yeah, it is. It's an integrated signals, intelligence, and electronic warfare system, goes right to Army soldiers, gives them vital battlefield awareness, detect, locate, disrupt enemy comms and electronic systems, all from a portable unit. Game changer. And their CUAS, counter-drone tech, it's been so effective it's led to international expansion. They got a new contract providing it to the Canadian Armed Forces.
Yeah.
Shows the global relevance of their proprietary solutions.
Interesting. Okay, next up, space, the final frontier. How is CACI, traditionally IT and services, involved in something as complex and hardware-heavy as space? Seems like a big leap.
It is a significant leap, but aligns perfectly with their tech pivot. They see space as absolutely critical for national security, investing heavily in next-gen comms tech for that domain. For instance, they advanced to Phase 2 of the U.S. Space Force's $100 million Enterprise Space Terminal program, developing cutting-edge laser-based communication terminals for military satellites.
Laser comms in space.
Yeah. Unlike traditional radio frequency, lasers offer way higher bandwidth, are much harder to intercept or jam, need less power, ideal for secure, high-speed data transfer in space. Truly frontier tech, crucial for strategic advantage. And finally, their deep involvement with the intelligence community, IC, and mission support.
The IC, probably one of the most demanding, secretive customers out there.
Mhm.
What kind of impact is CCI having?
Indeed. The IC is the pinnacle of demanding clients. Needs absolute precision, discretion, advanced capabilities. CACI has a very deep, growing presence there, built on decades of trust, proven performance, underscored by recent big contract wins, nearly $638 million in new contracts announced May 2025 across various IC agencies, a 7-year task order up to $616 million for classified mission support, another $434 million task order for digital financial management solutions in the IC.
Wow.
These wins show those deep, trusted relationships. Their proven ability to deliver highly specialized, mission-critical support, advanced analytics, complex system integration, foundational to the IC's effectiveness.
Okay, let's dive into the numbers. Can be dense, but so crucial for understanding the health. Where does CACI's money actually come from? Let's break down revenue by customer, contract type, role, offering.
Yeah, this granular analysis really confirms their strategic focus, their deep entrenchment, shows where the efforts are paying off. First, by customer type. A remarkable 75.4% from the Department of Defense, another 20.6% from federal civilian agencies.
Heavily DoD focused then.
Very. That concentration, while maybe a potential risk if defense spending plummeted, also signifies those deep, trusted relationships, formidable barriers to entry, and alignment with those enduring funding streams. Moving to by contract type, 60.7% is cost plus fee, 26.1% fixed price, 13.2% time and materials.
Okay, can you quickly recap those contract types?
Sure. Cost plus fee. Government pays approved cost plus a fee.
Yeah.
Lower risk for CCI. Fixed price. CCI agrees to deliver for a set price. More risk for them, but potentially higher margins if managed well.
Got it.
So this mix shows a balance. Managing risk on big development projects, cost plus. Taking more performance responsibility on mature solutions, fixed price. Next, by role. A dominant 90.1% as a prime contractor.
Prime, meaning they lead the project.
That's exactly. Strong indicator of direct client relationships. Capability to lead large, complex projects. Not just a subcontractor. Speaks to their leadership. integration skills. And again, the numbers clearly show the pivot when you look by offering. 54.3% technology, 45.7% expertise. That successful strategic pivot we talked about. It's right there in the revenue split. Tech is definitively the larger contributor now. Hashtag Yuri. Historical performance analysis, FY23, FY25.
Okay, so that's the current snapshot. How has this focused strategy translated into financial results over the past few years? Consistent, peaks and valleys.
It's been a very consistent, impressive track record, steady upward momentum. Look at revenue growth. From $6.7 billion in FY23, jumped to $7.66 billion in FY24. That's a 14.3% increase.
Yeah.
Then to $8.63 billion in FY25, another solid 12.6% increase. And importantly, that includes robust 7.2% organic growth in FY25.
Yeah.
Meaning a lot came from existing operations. New wins, not just acquisitions. Shows underlying strength.
And profitability.
Strong profitability trends, too. Net income grew steadily. $385 million in FY23, up to $500 million in FY25, drove a big jump in diluted earnings per share, EPS, from $16.43 to $22.32, growing value for shareholders. Their EBITDA margin was a healthy 11.2% in FY25. EBITDA, basically core operating profit before interest, taxes, depreciation, amortization, shows solid operational efficiency, good cash generation from the core business.
Right.
And with long-term visibility, their backlog and book-to-bill are key. They maintain a huge total contract backlog, $31.4 billion as of FY25.
$31 billion. Wow.
Yeah, provides incredible visibility, about 3.6 times their last 12 months revenue. Means a big chunk of future revenue is already locked in. High predictability. And their book-to-bill ratio of 1.1x for FY25 means they won $1.10 in new work for every $1 they recognized in revenue. Very strong sign of future growth, pipeline strength, hashtag CACI. Latest quarterly performance, Q4 FY25.
That historical performance is pretty consistent. What about their most recent quarter, Q4 FY25? Is the momentum continuing?
Any slowdown? Nope. Q4 FY25 showed clear continued momentum, strong execution for the quarter. $2.3 billion revenue, up a healthy 13% year over year. Adjusted diluted EPS came in at $8.40. Significantly beat market expectations, shows operational efficiency, delivering on promises. And they maintained a strong EBITDA margin of 11.5%. Reinforces that healthy profitability trend. They're not just growing, they're consistently exceeding expectations, performing effectively.
Okay, looking ahead, what's CICI projecting for the next fiscal year, FY26? This usually gives the clearest glimpse into management's confidence, right?
Right, and this is a critical point, really highlights their strategic success. For FY26, they project a revenue of $9.2 to $9.4 billion, adjusted net income between $605 and $625 million. Adjusted diluted EPS of $27.13 to $28.03. Strong growth numbers across the board. Continued expansion top and bottom line.
But here's where it gets really noteworthy, maybe more than revenue. Their free cash flow guidance, often called the lifeblood of a company.
That's exactly. Free cash flow is paramount. Cash generated after covering operating expenses and capital expenditures, what can be returned to shareholders or used for strategic investment. CACI anticipates generating at least $710 million in free cash flow for FY26.
$710 million. That's a huge jump from FY25's $442 million.
It is a truly significant acceleration. Disproportionate growth relative to revenue, and it's not an accident. It's a direct result of their multi-year strategy. As large programs mature, they become less capital intensive. Move past heavy initial investment, start generating stronger cash flows, couple that with disciplined working capital management, the margin boost from the growing tech segment. Boom, surge in FCF.
And that gives them options.
Huge options. Substantial financial firepower for future M&A, maybe bigger deals, or increased share repurchases. Immense flexibility for value creation. Clear sign of financial strength maturing. Hashtag GE, capital structure and deployment.
So with all that cash flow, a clear strategy, how do they manage the balance sheet, deploy that capital?
They maintain a very healthy, well-managed balance sheet. Leverage is manageable. 2.0x net debt to EBITDA as of May 2024. Generally, 2-3x is seen as healthy for this type of company, not overly reliant on debt.
Yeah.
They showed their access to capital recently, raising $1 billion through senior notes in May 2025, supports that flexible capital deployment. Includes completing strategic acquisitions like Azure Summit Technology we mentioned, and their ongoing share repurchase program still had $337 million authorized as of May 2024.
No dividend though, right?
Correct. Important for investors. No current dividend. They prioritize reinvesting in growth, strategic investments over immediate payouts, common for growth-focused companies. And digging a bit deeper into financial health, at 11.2% EBITDA margin is solid. Return on capital employed, ROCE, was 10%. Return on equity, ROE, 13.35%. good metrics showing efficient use of capital. Critically, net income and cash from operations track closely. Strong sign of high-quality earnings profits convert to actual cash. And the business is low capital intensity. CapEx is only about 12% of cash from operations in FY25. It means they don't need huge spending on physical assets to grow. Frees up cash for R&D, acquisitions, buybacks.
Okay, CSCI operates in a massive market, one of the biggest, most complex, U.S. federal contracting. How big are we talking? What are the major forces at play?
Colossal is the right word, a huge economic engine. Annual obligations range from what, over $693 billion up to nearly $800 billion. It's about 3% of the entire U.S. GDP. Not just a sector, a significant chunk of the national economy.
So for CCI and others like them, what does that scale mean? Stability? Or just amplified challenges?
A bit of both, really. While the market always has some political uncertainty, budget debates, there's currently robust, often bipartisan, support for defense and national security spending, driven by a heightened global threat environment, cyber threats, geopolitical tensions, great power competition. CACI's strategic focus on these enduring funding streams provides a significant degree of insulation from broader discretionary spending cuts. These aren't areas the government can easily slash without major security implications. Aligns perfectly with their value creation models. Pillar 1 offers a strong, fundamental demand signal, #B, procurement processes and challenges.
But even with a massive, generally well-funded market, it can't be easy winning and managing these incredibly complex government contracts, right? It must be huge hurdles.
It's far from easy. It's an incredibly challenging, unique environment. Raises the question, what are the unique challenges just to operate and grow here? One major hurdle. The government budget process often relies on continuing resolution CRs, temporary funding, but they can significantly delay new programs, restrict new contracts, create uncertainty.
Yeah, CRs always seem to cause headaches.
They do, and the procurement process itself, notoriously complex, lengthy, can be delayed by bid protests from losing competitors, ties up contracts for months, sometimes years, plus the whole industry faces intense competition for a limited pool of highly skilled technical personnel with the necessary security clearances. Getting and keeping those clearances is long, costly, makes specialized talent scarce, valuable, essential for CTI's work. #C. Key industry trends and CTI's alignment.
So, given these dynamics, these challenges, how is CCI positioned within these broader market trends? Swimming against the current or riding a wave?
They very strategically align their capabilities to capitalize on several powerful macro trends reshaping government contracting and national security. First, technological imperatives. The government is prioritizing massive investments in advanced tech to maintain its edge. Key areas: cybersecurity, space resilience, EMS operations, AI, IT modernization. These map directly to CCI's core investment areas, their differentiated capabilities, perfect strategic fit. They're investing ahead of need in these exact domains.
Second, a fundamental shift to technology in national security thinking. Growing understanding that bits and bytes, non-kinetic capabilities like software, cyber tools, secure comms, data analytics, are becoming as critical, maybe more so sometimes, than bullets and bombs. Information advantage is key.
Right.
This provides a powerful long-term tailwind for CCI's entire tech-focused strategy, validates their pivot. Finally, innovation and speed. Government customers want faster delivery, no more slow, multi-year development cycles, leading to more agile acquisition vehicles, preference for contractors using agile, DevSecOps. CSI's expertise here makes them a preferred partner for these next-gen programs, prioritizing rapid secure deployment, #DD, competitive landscape, and strategic positioning. With such high stakes, such a massive market, who are CCI's main rivals? How do they stack up?
Primary competitors are other large-scale government services and tech providers. Names you'd know: Booz Allen Hamilton, BAH, Leidos, LDOS, Science Applications International, SAIC. They also compete with major defense primes like Northrop Grumman on specific things, even large commercial consultants like Accenture for certain IT modernization projects. But if we connect this to Porter's 5 forces analysis, what's fascinating is how the industry structure actually protects established players like CCI, gives them an inherent advantage. The threat of new entrants is low. Formidable barriers need extensive past performance, significant capital, large workforce with high-level security clearances, very tough to break in. Bargaining power of buyers, U.S. government, is moderate. Yes, single powerful buyer, but mitigated by high switching costs for complex embedded systems. And CSCI's specialized, often proprietary solutions limit easy substitution for mission-critical tasks. Bargaining power of suppliers is low to moderate. Primary input is specialized labor. Market for cleared people is tight but fragmented. For tech inputs, they're often large customers themselves, giving them purchasing power. Threat of substitutes is low for their mission-critical national security work. Virtually no direct alternatives outside its peer group for what they provide. However, rivalry among existing competitors is high, intense competition among well-established players, constantly vying for the same finite pool of large contracts, competition on tech merit and price.
So, given that fierce rivalry, how does CCI stack up on the numbers? Does that strategic pivot show up in their valuation?
Absolutely. Look at a quantitative peer comparison. CCI is smaller than Leidos, Booz Allen, and revenue market cap, but it trades at a premium price-earnings PE ratio, around 22.17 for CCI versus maybe 12.50 for BAH, 15.59 for Eldos.
So the market values their earnings more highly.
Exactly. That PE premium is a strong signal. Suggests investors are pricing in significantly higher future earnings growth for CCI. Directly reflects confidence in that successful strategic pivot to higher value, higher margin tech. Market sees them as a growth company in a stable industry. And a quick SWOT analysis sums it up. Strengths: strong position in high-priority markets, differentiated techie, like Archon, robust backlog, successful M&A track record, strong culture helping talent retention. Weaknesses: high dependence on U.S. government spending, customer concentration risk, smaller scale than some larger peers. Opportunities: continued growth in IT cyberspace budgets, potential for international expansion, like that Canadian contract, leveraging AI for solutions. Threats: unforeseen budget changes, increased pricing pressure, contract delays from political gridlock CRs, intense competition for cleared technical talent.
Okay, as we look towards the horizon for CSCI, what are the specific factors that could really propel their growth, drive value in the coming years? What should we be watching for?
Several key catalysts are definitely in play. Suggest continued positive momentum. First, major contract adjudications. CACI has a huge pipeline, about $11 billion in submitted bids awaiting award. Another $15 billion expected to be submitted soon. Most of that is new business. Key wins here, especially large tech contracts, could significantly accelerate growth, expand that backlog further.
Right, those big wins move the needle.
They do. Second, continued margin expansion from the technology mix shift. As that higher margin tech segment keeps growing as a percentage of total revenue, replacing lower margin expertise work, overall operating margins should expand. Drives faster growth in net income, EPS, more potent profitability. Third, that accelerated capital deployment we talked about, fueled by that projected FY26 free cash flow surge over $710 million. Provides significant capital flexibility, can strategically deploy it to accelerate share buybacks, boosting shareholder returns, or pursue larger, maybe transformative M&A, opens new areas, solidifies dominance, and finally, international expansion. Those early successes, like the Canadian counter-drone contract, show a viable path for geographic expansion beyond the U.S. government. Still smaller, but diversification offers powerful long-term growth as global allies seek similar advanced capabilities. Recent news: big wins with Army Intel, advancing the Space Force laser comms, that Canadian deal, all reinforce these catalysts in action. #B primary investment risks.
But it's never a smooth road, is it? What are the main risks, the potential headwinds that could challenge this positive outlook for CCI?
Right, outlook's positive, but crucial to be aware of key risks, mostly external, largely outside their direct control. One is the budgetary headwinds. Defense spending is strong now, but a major unexpected political shift, economic downturn, or prolonged government shutdowns, restrictive CRs that would impact revenue, project starts.
Always a risk in this sector.
Always. There's also program execution risk. Their backlog has large, complex fixed-price contracts. If they hit significant cost overruns, performance issues, that could hurt profitability, reputation. Another is M&A integration failure. Their strategy relies on successfully integrating acquisitions. If it doesn't go well, operational disruptions, cultural clashes, they might not realize the expected tech and financial benefits.
Yeah, integration is always tricky.
It is. Finally, competitive pressure. Market remains intensely competitive. Many capable players fighting for the same contracts, aggressive bidding from rivals, innovative solutions from new entrants, could lead to lost contracts or pressure on CSCI's margins. But, important to clarify, the risk of catastrophic or total loss here is extremely low. The CACI is a well-established, profitable, multi-billion-dollar company. Backed by long-term government contracts, that huge $31 billion backlog, the main risk is stock underperformance versus expectations or peers, not a total loss of capital. #tag management governance.
You touched on leadership, but are management's motivations really aligned with long-term success? And critically, with shareholders? Always a key question.
What's reassuring here is the strong alignment. Executive comp at CCAI is directly tied to key metrics: revenue, EBITDA, free cash flow. ensures their incentives align with value creation. Plus, insiders hold meaningful stock. CEO John Mengucci owns 0.51% worth over $55 million. That personal investment means their financial interests are deeply intertwined with the company's performance.
Skin in the game.
Definitely. They also have a formal clawback policy for incentive comp. Adds accountability can recover bonuses if targets aren't met or there's misconduct. And they keep a modest burn rate for comp plans, avoid excessive dilution from issuing new shares to insiders, protects existing shareholder value, #####D, the concluding investment thesis.
So after this deep dive into CCI International, what's the big takeaway? The concluding investment thesis for listeners thinking about this company.
CACI International has successfully executed this multi-year deliberate strategy, effectively transformed from a traditional government services provider into a technology-first contractor. They're meticulously focused on the most critical, resilient, well-funded segments of the national security market. Their robust backlog, consistent financial performance, clear alignment with enduring government priorities. It provides a visible, predictable path for continued future growth.
It really sounds like that investing ahead of need strategy isn't just a slogan. It's genuinely delivering results, differentiating them.
It absolutely is. It's allowed them to create and acquire this powerful portfolio of differentiated high-margin tech offerings, provides a durable competitive advantage. And this strategic positioning is strongly validated by their financials. Revenue mix favoring tech, strong expanding profitability, that projected surge in free cash flow giving immense strategic flexibility. While the stock trades at a valuation premium to some peers, that premium seems justified by CACI's superior strategic focus, higher growth profile, potential for continued margin expansion. For growth-oriented investors with a long-term horizon, CACI presents a compelling, well-positioned story in a critical industry. #outro desire.
Wow. Okay, that was quite the deep dive into CCI International. We've really journeyed from, their beginnings back in '62 as a small analysis center to this powerhouse in national security tech today. We've seen how that investing ahead of need philosophy isn't just catchy, it's a real strategic engine driving their pivot towards those higher margin, differentiated tech solutions so critical now.
Yeah, what truly stands out is KCI's disciplined, forward-looking approach, identifying and fulfilling critical government needs, especially in areas like space comms, EMS dominance, network modernization. Their consistent success really underscores the increasing importance of sophisticated bits and bytes in modern defense and intelligence, makes them this quiet but truly indispensable force behind the scenes.
So, as companies like CCI keep embedding cutting edge tech into the fabric of national security, it raises an interesting question for you, our listener, to think about. What are the long term implications for global power dynamics as that line between traditional defense and advanced tech gets increasingly blurred? How might this quiet revolution in bits and bytes reshape international relations, maybe even the nature of conflict itself in the decades ahead? Something to mull over until our next deep dive.